Today we'll speak about Secure Act 2.0, and I will give you a bit of background where it came from, what happened. There is a lot of provisions that outline this law. It's more than 100. So we won't be able to cover all of them today, but I'll cover major ones that most likely will be most applicable to you at the moment. So let's begin. First of all, the Secure Act 2.0 came from a Secure Act 1.0 that was enacted a couple of years ago. Now, this year, the new law has begun right at the beginning of the year. They passed the law on December 29th. And then starting from that point, there is a ladder of when each provision gets into effect. Most of them effective starting right at the beginning of 2023. However, some of them will go into effect 2024. As we go through presentation, I'll outline which ones starting now and which ones will be effective later on. There is a lot of provisions. We need to be very careful about how they work because it does affect the retirees, and a lot of retirement planning needs to be done around that. So let's talk about most important and probably most favorable provision, which is required minimum distribution. It's been pushed out. Secure Act 2.1 pushed out RMDs from 70.5 to 72, which was already a great news. Now Secure Act 2.0 expanded it even further. So they now allow for those people that were born 1950 and earlier to begin their RMDs at age 72, not 70.5, and people between 50, one was born between 51 and 59, please note, now you will be required to take distribution of 73. Anybody who is born after that will benefit from pulling their RMDs at much later age, which is 75. Advantages of that is huge because now you don't have to take the money out, you don't have to pay taxes, you can still grow it tax deferred and defer any taxation and distributions based on an RMD at a later age. So that's a great news for a lot of people who will be getting soon into RMD age to wait a couple more years without those unnecessary, potentially, distributions and taxes. Now let's talk about penalties. We hear all the time that people missed the distribution or they forgot to take it from a particular account that was forgotten. But that's the good news now that the penalty will be reduced from 50% very heavy penalty on the amount that hasn't been taken out to a 25% penalty. Furthermore, if it's corrected during a correction window, which is outlined below, the penalty is only 10%. I've seen if you write a letter to IRS stating that you forgot and state a good reason why and ask for forgiveness, they often do not levy any penalties on the retirees. But you need to correct it within the correction window, which is either the earlier it is imposed and ends at the earliest of notice of deficiency that mailed to you. Tax is assessed by the IRS on the last day of a second tax after the tax is imposed. So there is limitations how we can correct it, and ideally you catch it sooner so you don't have to pay a penalty or pay very little penalty. That effective as of 2023 January. So not as heavy penalty as used to be before. Now let's talk about statute of limitations from RMDs. So if you didn't take them out, you're not going to be penalized for the rest of your life. RMD shortfall is only 3 years. After 3 years, they cannot levy you penalties. And excess contribution, sometimes when you make too big of a contribution that you're not eligible, often it refers to Roth accounts, then it's a 6-year statute of limitation. After that, they cannot go after you. So that's good news again. For those who will not be audited between 3 to 6 years time horizon, they don't need to worry about that. Let's discuss a bit more about the RMDs and required distributions and any distribution from the retirement account for a surviving spouse. So there is new options that came along. Currently, in 2023 and before, you can roll the deceased spouse IRA into your own IRA and treat it the same way. You could also treat decedent's IRA as their own if it's more advantageous. For instance, the person who passed away, your spouse was younger, then you can just use their table and roll it, take required distribution based on that table. or remain as a beneficiary IRA of the decedents. Now, the third option available, my understanding previously was only for non-spouse. Beneficiary IRA usually available to non-spouse beneficiaries, usually children and other family members. Now, post-death option for surviving spouse starting 2024. You can elect to treat as a deceased spouse, providing the following benefits to the surviving spouse. First, RMDs delayed until the deceased spouse would have reached RMD age. So RMD can be delayed and be based on the age of the deceased spouse. So once RMDs are necessary, surviving spouse will calculate RMDs using, we call it uniform life table, not the single life table, which is also advantageous. And the third, should the surviving spouse die before RMD begins, beneficiaries will be treated as though they were at the original beneficiary's age. So this will allow you to push out the RMDs if your spouse was younger. Now, please do not confuse it with required minimum distributions for non-spouses. For non-spouses, the new law that passed by Secure Act 1.0 does not allow the stretch IRAs anymore, which means that if the beneficiary is not a spouse, you have to take the funds out within 10 years. And you can start at year 1, you can start at year 10, you can take smaller amounts out, but the amount that's in the IRA account has to be depleted by the year 10. That's for IRAs. It's also applicable for Roth IRAs, from my understanding. Roth IRAs, even though they are not taxable, IRS still wants you to take the money out and use it up. So that's completely different rules. They're not the same as for a spouse. And we need to be very careful not to forget to take the RMD by year 10. You need to talk to a tax preparer or your financial planner to see if there's advantageous years where your income drops and then you can take a larger amount from your beneficiary IRA and pay less taxes. Let's look over Roth account changes. So few things that will change the way the RMD was required on the retirement plans like 401k, 403b, 457. We used to be required to take RMDs from Roth retirement plans. Now you are not. You can just leave it alone. You don't have to roll it into your IRA or Roth IRA. You can leave it the way it is and you don't have to take the money out. It's not required anymore, effective 2024. Simple and SEP Roth. So previously, if you're self-employed, you would not be able to have a Roth option for your simple plan or SEP IRA. Now, SEP IRA and simple IRA, based on a new law, can have an option to put money away on the Roth basis. So let's talk about pre-tax versus after-tax. If we're talking about on a pre-tax basis, this is the regular contribution into SEP IRA, and it's tax deductible. Now, if you're not benefiting from taxes as much, maybe your tax bracket is low, maybe you want to set up a Roth account, now your SEP IRA will have that provision available. You need to give regulators and also brokerage houses a bit of time to adjust the application, to adjust the system, because right now, not too many have that option available. But in the next 3 to 6 months, we will see this option become available because it's effective as of January 2023. And the financial institutions are working very hard to get that amendment set up. So Roth account options is there. It's a great option because anything that grows into the Roth IRA, into the Roth 401k, into the Roth SEP IRA, it grows tax-free. So if you put $5,000 in that account and that account 10 years down the road is $10,000, whatever you take out after 5 years or after age 59 and a half has no tax liability. Great account to have, great tax benefits. Employer contribution eligible for the Roth treatment. So it's a more expanded version. We used to be able to have Roth 401ks. It still stays, but there is one difference that now applicable to the Roth 401ks. We were able to put all the money in our 401ks on the pre-tax level, reducing our tax liability. What's happening now is that the Secure Act outlined that if your wage exceeds $145,000 adjusted for inflation in a previous calendar year, you're not eligible to put a catch-up contribution into your 401k on a pre-tax level. You can do it on after-tax basis, and you can put it into the Roth or you catch up, which is a 5,500. You cannot do it on a pre-tax level. So this is a huge change, because obviously if you are over 50 today, your total contribution between regular and catch up is $22,000 plus another 7 or 8. You can totally put $30,000 in. Before this law, and by the way, it's effective 2024. So this year is still good. So it's $30,000 can go, if you're over 50, into your 401k in 2023 on a pre-tax level. Starting 2024, once you reach income level of $145,000, I believe this is for single filers, but I don't, we need to double check that number. If it's for single filers or joint filers, then you can only put away $22,000, which is your regular 401k contribution. All the catch-up amount, it has to go into your Roth. So you will not be able to deduct that additional $8,000, which is a bummer, because we want to deduct as much as possible once we contribute into the 401k. Now the income limitation will disallow us to put any catch-up amount on a pre-tax basis. Plans that do not permit any catch-up contributions to Roth accounts basically will not allow us to make any contributions that are catch-up. So unfortunately, you no longer can say, well, if my plan, I can do everything on the pre-tax, I don't need the Roth provision on my 401k. Well, guess what now? If your 401k doesn't have a Roth option, you're basically missing on the entire catch-up contribution. So that's really not a great way to continue saving for retirement, but it is what it is. This is the new law. Let's look over real quick another option that actually expands amount of money you can put on the pre-tax level, and that's called, we call it mega catch-up. So it's increased catch-up contribution for older employees. So remember, if your income is below $145,000, you can still make this mega catch-up on the pre-tax level, and it's applicable to 401k, 403b, 457. It's a $10,000. So it's a higher number than today's number, or 150% of a regular catch-up contribution in 2024. Last time I calculated, it was about $11,250 or so. So remember that your catch-up contribution right now is below $10,000. In 2024, if you are aged between 60 and 63 only, you will be able to do a mega catch-up and put away that money on the pre-tax level if you are making less than 145,000. If you're making more than that, you can still do a catch-up, but it has to go into your Roth 401k, and it's not tax deductible. A simple IRA has a similar provision. It's basically $5,000 or 150% of the regular catch-up, probably estimated about $6,000 or so. So catch-up is great. Mega catch-up is even better. We just need to make sure that we can put it on the pre-tax level, and if we do, your tax liability decreases. 529 accounts. I don't know if you've heard of that yet or read somewhere online. This is a huge change. Any 529 accounts that hasn't been used up for college education, and you believe they will not be used up anymore, you don't want to pass these accounts to your grandkids and grand-grandkids, you can allow this money to be rolled into your beneficiary Roth accounts. The amounts are limited. It's a lifetime amount of $35,000 max. Effective date is actually January 1st, 2024, so next year. And these amounts of 529 needs to be, we call it seasoned, means you have to keep this money. So these contributions into the account, they have to be there for 5 years, last 5 years, plus earnings. That's the only amount that's eligible for transfer.
So we need to realize we can't just put money immediately roll to the Roth. They need to sit and grow in 529. 529 account needs to be maintained for more than 15 years. That's a very long time. So basically, they say, if you have never used 529 and the kids are out of college and this account has been around for 15 years, you're eligible to roll certain amount of dollars from the 529 into the Roth account and continue growing tax-free. Now, remember one thing, that the amount that can be rolled each year is not $35,000, it's $35,000 total, and each year is whatever the Roth contribution limit is. If it's only $7,000, you can only do $7,000 each year to roll it from 529 into the Roth account. So even though this is the great option, unfortunately, it's quite limited because it's only maximum lifetime transfer of $35,000. Now, if you have two 529 accounts, then you can do double it. So maybe you have one 529 accounts, but you have two kids. Maybe it's idea that if your institution allows to split this account into two, and then if your balance of the account is $70,000 or more, then you potentially can roll the entire amount into the beneficiary Roth IRA. Why Roth IRA is so powerful and why they're so desirable? Simply because a Roth IRA is never taxed. So it doesn't matter how long you held the money in the Roth, it doubles, it triples, quadruples, you will not take taxes out when you pull the money. You will not pay taxes when you pull money out. Also, Roth accounts is a great source for kids to buy a starter home, to use some of that money for down payment, because if you take out any principal from your Roth account, as long as the account has been established for 5 years or more, you can take a principal out, use it for down payment, and there is no penalty, even though the child is not 59 and a half. That's another way for you to help them finance the purchase, another way for them to have access to the money should they need it. I don't want to stop too much on a simple IRA because I think not too many people have them. They're not very popular, but there is an employee contribution limit based on number of employees, and there is some advantages of additional contribution you can make on the behalf of employee based on a new law. If you would like to get more information, happy to discuss with you if you're the one who has a simple IRA. Now, QCDs stands for Qualified Charitable Distributions. It's a distributions from your retirement account that's $100,000 or less annually that will not be taxable if the money going to a qualified charitable organization. Example is that you would like to make a charitable contributions from your savings account, which means the money in your savings already been taxed, right? It's been taxed, it's kept in the savings account, now you're writing a check to your charity. The better way to do it, if you're as of age of 70 and a half, you can take out money from your IRA and write the check directly to the charitable organization without accruing any taxes, because any distributions from IRA otherwise will be fully taxable and goes to a new tax return. But if it's going toward the qualified charity, that amount of money that was sent to the charitable organization is not going to be taxable at all. So this is a great option for those people, especially those who are in RMD age and they do not need as much distributions from the retirement assets. They have other assets to live on. If they require to take RMDs and pay taxes, I encourage you to look into this option. And you need to also compare, am I standard deduction? Am I itemized deductions? If my charitable contributions allow me to increase my itemized deductions, please use that option and just write check to charity directly. But if you're doing standard deduction, writing check out of the savings account does not help you because you will not be able to deduct it. This way, I would suggest potentially to switching to a QCD, qualified charitable deduction contribution that will, or distribution that will allow you to contribute to charity on the pre-tax level without incurring additional tax liability. It's a great option to have. And usually people use it after age 72. There is a lot of provision in this act that basically allow people with terminal illness, victims of domestic violence, to take some savings out earlier, sooner, without a penalty if they're before 59 and a half. And they have to, you don't have to, I believe, justify it as much as they used to be. We used to call it hardship provisions. You don't need to be at hardship. You just need to specify that this is what it is, and you'll be able to access money without penalty. If somebody is interested, let me know. I can send you more information on that. Now, emergency withdrawal, long-term care distributions. That's a new provision where they say if you have an emergency, you can withdraw some amount of money. Honestly, when I read through that, I realized this is not going to help a lot of people because the amounts are so small. So these emergency withdrawals are not going to be very effective. If you have an emergency, $1,000 doesn't sound like a big emergency to me. So there is some limitations. Long-term care distributions. There will be a penalty-free qualified long-term care distribution to pay for the insurance, and limits of 10% of vested account balance of $2,500. That's a little bit more helpful because if you want to pay out of your IRA accounts long-term care payments, and you want to use this money instead of money from your savings, potentially you'll be able to do it. So we need to look at it. Hasn't been done before, so we need to see if there is any potential pitfalls. There is another act, another provision in the act about emergency savings account. Again, not powerful enough, by my opinion, because contributions are capped at $2,500. They have to be kept in a separate account. It's not invested, it's just sitting like a savings. So it's there, but the amount you can take out is very limited, as $2,500. So you will investments limited to cash, interest-bearing deposits, and preservation accounts, also effective next year, not this year. So this account must be linked to employer-sponsored retirement plan like 401k. You can fund it with the Roth contributions and can have access to that money. So still better than nothing, but it's kind of defeating the purpose of investment account like IRA or Roth or 401k. If the money sits in the savings, they're not earning enough interest to keep up with inflation. But these funds will be available if you decide to open this emergency savings account as part of your 401k. Employee located in the federally declared disaster areas also get some tax-free penalty distributions, and the amount is larger, it's $22,000. So we can talk more about it. There are some employees that are eligible for that, not too many though. Distributions to firefighters, public safety workers. There is some ability to take money out without penalty before the 59 and a half age, which really helps. And there's a really expanded definitions of that. We haven't seen it before. So there is more leeways to how to access your retirement accounts, especially if it's a special group of people without paying 10% penalty. Another interesting change is that we noticed that the starter 401ks, which people always try to rush to open their company 401k or their self-employed 401ks, they have to be established by December 31st, people rushing to get it open and funded. Now it's been softened up, the due date. You don't have to do it, especially for the solo 401ks. You don't have to open it till your tax filing deadline. And if you file an extension, you can open your solo 401k for the previous year all the way till October current year, which is a huge help. So now the deadline for SEP IRA funding, SEP IRA account opening is the same as for 401k. How previously it was SEP IRA, you can open an account all the way till October, fund it all the way till October tax filing deadline if you're on extension. Now 401ks fall under the same category, which is fantastic. Why? Because you can put into 401k accounts as a self-employed person by far more than you would do in a SEP account in general. That's a general rule. So that's a good news, a little bit more stretched time for you to think about, do you need it, you don't need it, talk to a financial advisor, tax person. So I think it's a really nice
way of giving people more time to decide on the contributions and advantages of doing so. A lot of new provisions as far as 403B plans. I don't want to touch too deep on this because it's really very specific to employees of the nonprofit organizations, of schools, colleges, hospitals. So unless you are in that particular area, I would be happy to discuss it, but it's a very nitty-gritty details. I don't think we want to get on that. And student loan payments treated as an elective deferral, which is very interesting. So basically they're saying if you repay your loan, and the employer may require to treat qualified student loan payments as elective deferrals. So basically elective deferrals means your contribution into your 401k. And for that reason, employer can even match that. So some young people are just starting work, they cannot put money into 401k because they're burdened by the loan. Guess what? When you are repaying your loan, it's treated as your employee contribution and the employer can match that contribution. That's very nice. Vesting schedule and matching formula must be the same for loans. All of that, there's always the details in how it's done and when it's done. All of this is effective 2024. Retroactive solo 401k deferrals allowed for sole proprietors. We just spoke about it. So solo 401ks now starting 2023 can be opened and funded in the current year, but the tax deduction you can take for the previous year. Savers credit. This one is about military spouses, qualified longevity, annuity contract. All of this is very rarely used. However, if you're qualified birth or adoption distributions, you can use a 3-year time frame to repay the distribution. So there are some changes to that. We can talk a little bit more in details. It's not common, but please feel free to read through that. If that's applicable to you, we can discuss it further. If small immediate financial incentives for contributing to a retirement plan effective 2023. This allows participants to receive the minimum financial incentives not paid with the plan assets for contributing to a 401k or 403b. It's a gift cards for small amounts. It's not very often used, but they are expanding and saying that you can make it now more often. Now, let me just outline something. So what's not included in this particular provisions of this new act is limit thresholds for Roth conversion has not changed. A limit on the backdoor Roth or mega door Roth accounts. So let me remind you what the backdoor conversion means. I'll give you an example. You are a family that makes over $250,000 in Bay Area. That happens all the time, and you're not eligible because of your income to put money into your 401k. You're not eligible to put into your 401k into your Roth IRA directly. You're not able to do that, and you're already maxing on your 401k. You really don't have any other options but just sticking to the 401k. Your spouse, however, does not have a 401k. Spouse has your spouse has a 401k, but currently is not working at the company that make you eligible for any retirement plans. So you have a 401k sitting somewhere else, you have enrolled into the IRA, but you want to make any sort of contributions. So you have an option. If your income is low enough, you can make a pre-tax contribution into your regular IRA. But if your income is $250,000 or more, you're not eligible for the pre-tax IRA. You're not eligible for the Roth IRA. The only option left for you as a spouse or another working spouse is to do a backdoor conversion from IRA to Roth. So what you do is you make a contribution into your IRA account, and it's not deductible, and you immediately roll into your Roth account. So you're basically avoiding those limitations by doing non-deductible IRA contribution, for, let's say, for 2022, which is $7,000, and you can immediately also make non-deductible IRA contribution for 2023 because we're in a year which is 7,500. So 14,500 can go into your non-deductible IRA immediately, and once there's money in the account, the next day you roll it into the Roth account. This is how you avoid this limitation to put money directly into Roth. So that stays, nothing changed there. And also there has been no updates how the beneficiary can take money out within this 10-year period once they inherit the money. So we still understand you can take it anytime in any increments. Hasn't been any clarification on updates saying you must take it within certain schedule. So that's what has not been included in the act. Now, action plan. Action plan is probably, I think, the most appropriate is for you to evaluate a few things. First is if you're of age, which we just looked at, so let me pull it up one more time. I'll show you the age group, just in case somebody who joined later on. So figure out first if you're subject to these new rules. So people who are at certain age, actually those who are turning 72 this year, I don't believe any of them will be required to take required minimum distributions because you've been exempt. It was pushed out to the age of 73. So whoever turning 72 this year, they don't need to worry about the RMDs. So this is one of the biggest deal. I think it's really important to recognize those who are working, especially self-employed, and you're still looking for the retirement plan, you've been late to make contributions, you still have a time to do so. That's another big provision. I think it's extremely important. Those forgotten 529 plans, look into them to see if you're no longer planning to go to college or no one in your family planning to go to college and spend it. Maybe Roth conversion from 529 into the Roth account will be a very good option. So in general, this Secure Act is very robust. It does allow retirees to have access to their money without penalty. It eliminates RMD for people who are younger than 73. So a lot of good things happening. Also, we call it exercise tax on missed RMDs has been reduced. In general, it is much better for a lot of people who are over age of 70 plus. For those who are working, we also have ability to access the funds at certain circumstances, which are more critical at no penalty. And that's always been a very good way to, just in case, have that option. And in general, we also need to be mindful about if you continue working for the company, you do want to maximize your pre-tax contribution into your 401k to reduce your tax liability during your working years. And that will allow you, based on this new act, to do so between age 60 and 63. So few good things happening. Some emergency access funds, I don't believe that will be that important for a lot of people, but it's good for them to be able to see at least some abilities to pull the money out. So I think what I'll do is, I think I covered most of it. I have very nice summary I can share with you so you can take it and read it with you later on. But for now, I believe we will address some questions and maybe we'll do some clarifications. It's a brand new law. No one knows it very well. It's literally just been enacted 3 months ago, and we're all just learning about that. So, but I will be happy to answer any questions to see anything just came up. Maybe Lisa, we can open it for Q&A.
Sure, yeah. So if any of you have a question, please feel free to enter it in the chat box or unmute yourself. I see there is one question in the chat. Somebody asked, can you qualify section 103 savers match and section 104 promotion savers match?
And this is relates to the current act. So let me see.
I believe so.
So I'm not familiar with that. Let me take a look. So let me read it. Can you clarify section 103 savers match, section 104 promotion of savers match? I will look into that and I'll get back to, I know who asked the question. So I'll get back to you on that one just to make sure I give you the right information. Okay, so this is something new I need to research a little bit. So unfortunately, the system doesn't allow me to copy this question, but I'll try to.
Oh, okay.
I will try to.
Well, since I'm recording it, it should
We should be able to.
it should say the
Section
text on.
103 and savers match section 104. Okay, I'll remember
Okay.
that. So I'll look into that.
Okay.
So what
And-
pay or income is considered to be higher compensated? Does it vary based on the country or country of residence? That's interesting. So highly compensated. So there is, I believe, two types of highly compensated employees definition. One is people who will phase out of their IRA contribution, who are compensated above certain thresholds. We don't call them highly compensated. This is just a threshold for people who make over certain dollar amounts that will preclude you from making contribution into your IRA account on a pre-tax level or Roth account. Highly compensated employees are those who have a big gap between the regular employees and the highly compensated officers. So that relates to 401k, if I'm understanding your question right, relates to 401k safe harbor provisions, because ERISA rules says that you have to contribute equal amount of percentage wise to the non-highly compensated employees if you're making contributions, and highly compensated employees are making 401k deferrals. So it's more related on the safe harbor rules, and also relates to your ability as highly compensated to participate in the 401k or 403b. Now, does it change by the county? I don't think so. I think it's a federal law, and it does not change by the county. So highly compensated employees, it's not a dollar amount, it's the difference between how much the highly compensated make in this company versus the people who are regular rate. And then these two compared, and then a safe harbor rule has created to say how much you can put away as a highly compensated compared to the rest of the employees. And then if you contributed too much, they might return some contributions back to you to equal it out. I hope I answered it right. I don't know if it's exactly what you're asking. So let's see.
Okay, somebody, there is a question. It says, when we start taking money out of a 401k, how do we calculate the RMD at age 73?
So you already started taking contributions at this point? And how do you calculate RMDs? So RMDs are calculated. So first of all, if you're already eligible, so if you're a certain age, remember I showed you the table. So depending when you were born. So if you're required to take the RMDs, usually those amounts are automatically calculated by your financial institution, by your broker dealer. We always double check the numbers, but it's a uniform table based on your age. It will tell you what percentage you need to take each year, and based on a balance as of December 31st of the previous year. So depending on your age and depending on the balance of your account as of December 31st, there is a table. If you do need this table, send me a quick email. I can send it to you, or you can find it and Google it. So it's a uniform table that allow you to make calculations. I strongly suggest go by the number that your financial institutions provides you, because they are responsible for making this calculation right. But you can always double check using the table.
There's a question for an inherited IRA, if the amount is not taken up by year 10, what happens?
I believe, you know what, it's a great question, actually. I believe there'll be a penalty, have a penalty limit, but I didn't see actually how much and what. They just said it has to be depleted, but remember, it's probably a very similar rule than if we don't take RMDs from the regular accounts, right? Then we used to have 50% penalty, now it's 25. I think they will leave it a very serious penalty to discourage us from forgetting to take the money out. So I would say we need to do some serious planning, because if you are in the highest tax bracket right now, taking money from the inherited IRA does not make sense. if you can take it after retirement, as long as it's within the 10-year period of time. But if your income is low now and you anticipate it to grow, then taking some amount out of your inherited IRA makes more sense. So you need to run a tax comparison and to decide, okay, by how much do I take it out and it doesn't kick me in a higher bracket. And you need to run these illustrations for probably at least 5 years to see what's the difference.
Okay, thanks.
Sure.
It's the person who asked about taking money out from the 401k and calculating RMD at age 73. Do you have can you email that table that you referred to?
Oh, yeah, absolutely. Yes, I can
Okay.
find it. Yeah, I'll make a note. So, and I'll send it to Lisa, right?
Okay, thanks.
Let me, so uniform table. Okay.
Yeah.
So RMD uniform table. Yeah, I will definitely do that. So making sure that we have that. They change this table every year, pretty much every year because of the longevity. The people living longer and the tables do change because they always use it on average life expectancy. And because our life expectancy is increasing, the numbers in the table changes. Not by a lot, but they do change.
Okay. And can people find the table usually on the IRS website?
IRS website has it, yes. IRS has the website has it. Some financial institution carries the table. I also have a table. I try to keep the most current one myself so I can look at it. If people ask how much should we take out, we can pull the table out, multiply the number by the balance of the as of December, and we know exactly the amount. Also, remember one thing, which is probably most people know, you don't have to take your RMDs from every single account. You can aggregate it and see how much do you need to take entirely, so you are not subject to penalty, and you can take that amount from one place. So that
Okay.
it's easier this way.
Okay. Another question. Is it a good idea to convert all IRA to Roth IRAs and before withdrawing Social Security by reducing tax liability after retirement?
A great question. So it's actually depends. It's an excellent question that I get answered to this at least few times a year. It really depends, and let me explain you what I mean by that. So when you take money out of IRA and convert it into the Roth, that amount becomes fully taxable. It's reported on your 1040 and it goes into your Roth account to grow tax-free. Now, if your income after age of 70, even more after age of RMD, which based on your age is either 72, 73, or 75. If your income level and tax bracket is higher after age of 70, which another bump, right? If you're not taking Social Security out now, you wait until age of 70, you will have a high income at age of 70 by about at least $35,000. But if you wait so you're taking Social Security, but then if you have a sizable IRA account, you will have an RMD either at 72, 73, or 75. And if your account, let's say $1 million, you will have required minimum distribution of at least another $30,000. So Social Security of 35 plus another 30 to 35 of RMDs. Now we're talking about $70,000 of additional reportable income. So if your tax bracket from that age is much higher than today's tax bracket, converting IRA to Roth makes a lot of sense. Now the question is how much? If you convert the full amount and it kicks you in this 35% tax bracket compared to your bracket at 72, then it does not make sense. But if you make a small incremental conversions during your age, when you're retired, your income is low, you're not collecting Social Security, and you're paying taxes that will be lower than otherwise you would pay when you're 72, that makes complete sense. And you just need to be patient and careful how much you convert, so you're not converting too much to basically jeopardize the whole process of converting at a low tax bracket. But yes, the answer is yes, you just need to be careful how much you want to convert, and you need to compare a tax bracket. I would suggest sit down with your tax professional and take a look. How much is your tax bracket now? How much would it be if you convert X amount of dollars and compare it to your tax bracket at 70 and then at 73? And then you know exactly how much you can convert.
Okay, thank you.
Thank you.
And is there a point where you cannot convert at all?
Great question. I don't believe so. Let's think about it. So IRA distributions are mandatory once you reach certain age. Conversion is not subject to your being at certain age or certain income level. Used to be a long time ago, 10 years, but not anymore. So you pretty much can convert at any age and any time. Remember one thing though, as we get older, our life expectancy drops, right? So if you idea of conversion is you move money from a pre-tax account that's growing tax deferred to an account that will grow tax free. And meanwhile, you're paying taxes today. So you need to make sure that you have enough life expectancy for this Roth account to grow. And if it doesn't, you just converted significant amount of money. You're, I don't know, 85-year-old, your life expectancy 10 years or so, maybe less. And then the money just didn't grow enough to justify it. And then your beneficiary got the Roth account and they have to deplete it in 10 years. So it has to make sense. The money has to grow in a Roth account, tax-free, then this conversion becomes very valuable. So I would say there is no legal number, but I think any conversions after the age of 85 becomes less interesting, but it can make sense. If you want to pass on assets to your heirs without tax liability, and you want to prepay all the tax liability because you're a good parent, that's one way to do it, because your kid can inherit the Roth account, leave it alone for 10 years, and then pull the money out later without taxes. That's a possibility too.
Okay, thank you.
Yeah, well.
I don't see any other questions. Give it a couple of minutes. If anybody has, if there are any other questions, please enter them now in the chat.
And I will get back to about the section 103 in savers match. I just do a little bit of research to see what I can find out. It's an interesting topic.
So there is a question. Let's see. Do we need to pay tax again after receiving from deceased IRA, Roth IRA? So I maybe the question is, if somebody inherits a Roth IRA, is it tax free to them?
It is tax free.
Okay.
Yeah, the tax ramification does not change whether it's inherited or not. It's always free. It just in the old days you didn't have to take money out. You could sit there forever, but now you have to take it within 10 years. So because of the new law that passed 2 years ago. Yeah.
Now, Susan asks, do you recommend taking money out of a traditional IRA first?
It's a very, very specific question, because it really depends on your situation, and I'll explain what to look for. So taking money out of IRA, right, versus Roth, is that the question?
I believe.
Yeah.
So yeah,
Yes.
Susan, let us know if that's what you mean.
Right.
So if you have a choice between the Roth IRA and traditional IRA, and you are at RMD, which one do you recommend first?
So if you have a choice to push out your required to push out taxation, we always want to go for that. So if you have a choice to take out on an IRA, which is fully taxable, versus Roth, I would probably push out the IRA distribution to let it grow tax deferred and for you to pay less taxes. However, you need to look at some point of time, you do have to take the money out of IRA. So if in the future years, your income increases than today, then taking some money out of regular IRA is better. If your income will decrease as a result, tax liability and tax bracket as well, then pushing out distribution from IRA makes more sense, and take money from Roth. So it really depends. You need to sit down and see in the next 10 years, my understanding is question about inherited account. So, or if it's RMD age, for RMD, remember, you don't need to take money out of your Roth account at all. It's only the beneficiaries of the Roth account have to take it. So for the for you retirement planning purposes, I always tell my clients, unless there is special circumstances, leave the Roth account alone if you can. Let it grow tax-free, and only pull money out when you need it for health care, for large purchases, for emergencies. Because when emergency happen,
when you have to have a big purchase, when you need money for health care or long-term care, you want to take money out of Roth, not IRA. Why? Because there is no tax liability. If you take the same amount of money from regular IRA, you will have a humongous tax liability on your tax return that particular year. So I believe in taking money out of IRA incrementally through RMDs or a little bit more and leaving Roth to grow. That's the best account for you to have for the future. Also, if that money is inherited by your kids, guess what? There is no taxes and they will love it. So Roth account is one of the very special accounts that worth waiting to take in money from and take a little bit from IRA.
So if one only has a Roth IRA, does that person need to take the RMD out at the required age?
No, absolutely not. There is no RMDs on the Roth.
Okay.
Only on the beneficiary IRA Roth accounts, there is a distribution that needs to happen and the account needs to be depleted in 10 years. When you take it, how much you take it doesn't matter. But on your own Roth account, you're not required.
Thank you so much, Larysa.
Thank you very much, Lisa. My pleasure, as always.
Okay.
Have a good
All
one.
right.